tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hey folks, this is David McKnight. Welcome to the Power of Zero show. Grateful that you're with us for another consecutive week. We do not take your listenership for granted. As I'm the best-selling author of The Power of Zero, Look Before You LURP, The Volatility Shield, and coming out in exactly 1 week, something that I'm very excited about is Tax-Free Income for Life, the subtitle of which is a step-by-step plan for a secure retirement. And we're going to be talking more, going to give you some sneak previews of what that book is about today. I would be absolutely honored if you bought a copy and went over to Amazon or wherever you buy books and purchase a copy. And I would love it if you put a review on Amazon once the book is released. Amazon will allow you to do. If you are looking for someone to help you navigate all of the pitfalls that stand between you and the 0% tax bracket, head over to davidmcknight.com. We'll hook you up with one of the advisors in our elite POZ advisor group. They've been trained, vetted, and qualified, trained personally by me, so they understand the entire Power of Zero process and can shepherd you through all of the different steps that you need to complete to get at or near the 0% tax bracket in retirement. If you are a financial advisor who wants to transition your practice to a Power of Zero type practice, head on over to powerofzero.com and we can schedule a phone call and chat with you all about our program. All right. I'm excited to talk today a little bit more about the main thrust of my new book. And this is just designed to give you a little bit of a preview of what we'll be talking about in the book. Now, last week we talked about how guaranteed lifetime income or guaranteeing lifetime income by way of an annuity can have vast, surprising benefits, vast benefits including mathematical benefits, psychological benefits, and health/longevity benefits. In other words, yes, you can actually live longer if you have guaranteed lifetime income, and as opposed to the person who's sweating it out every year, hoping that the stock market gives enough rate of return to justify their withdrawal rate over time and hoping that they don't run out of money before they run out of life. Okay, so all of the discussion last week clearly begs the question, if there are so many mathematical, psychological, and longevity benefits that stem from owning an annuity that provides guaranteed lifetime income, and that's generally in the form of what we call a single premium immediate annuity. In other words, you give the insurance company a chunk of your net worth, a chunk of your assets, and in turn, they guarantee a certain income that lasts as long as you do. If that's the case, if there's so many benefits associated with this approach to retirement plan, of course, begs the question, why aren't much more Americans taking advantage of these types of programs? It turns out that there are 3 basic shortcomings that dissuade Americans from ever entering into the transaction. And we're going to go over those essentially 3 drawbacks that I've identified. We're going to go into those 3 drawbacks, and we're going to talk about how insurance companies have responded to that. And then we're going to introduce one final fly in the ointment at the end here today. And then next week, we'll talk about how a comprehensive Power of Zero strategy shows you how to neutralize that last fly in the ointment, as it were. So the first issue that Americans have with this type of approach that prevents them from ever adopting a single premium immediate annuity is this whole issue over liquidity. In order to enter into this transaction, if you recall, and let's just use the example of $500,000, you would, for example, hand $500,000 over to an insurance company, and in return, they might give you, say, $30,000 of income. This obviously depends on interest rates. It depends on your sex. It depends on how old you are, a number of different factors. But let's just say you give them $500,000, and in turn, they guarantee that you'll receive $30,000 every year until you die. Even if you live to 120, they will keep sending you that money. You'll keep having to find a way to try to spend it. Here's the problem. In order to pull this off, you have to surrender liquidity on a portion of your assets. You no longer have access to that full $500,000. You've given it to the insurance company. they in turn have given you this sort of private pension plan, and there's no way to undo that proposition. So if you decided somewhere down the road that you needed that $500,000 back, you no longer have liquidity on that money. And so what I found is that there's just something reassuring about having this vast supply of cookies sitting on the cookie counter that you can access at a moment's notice. People, there's something psychological about being able to access your money at a moment's notice. And so the act of giving up liquidity on a huge portion of your retirement savings is a huge dissuading factor for a large swath of Americans. So they never enter into the transaction. The second thing that really gives people heartburn is lack of inflation hedge. BIA, a single premium immediate annuity in its most basic form, does not index for inflation. So let's say you handed that $500,000 over to the insurance company and they give you in return $30,000 of annual income. That $30,000 may be perfectly adequate to cover your lifestyle needs in the here and now. But due to the inexorable effects of inflation over time, over 30 years, that $30,000 income, the spending power of that money gets chopped in half over that 30-year time frame. So it might be perfectly appropriate and perfectly adequate to cover your needs today, but 30 years from now, it's going to be worth half as much if we just assume inflation at 3%. And I think that given our propensity for trying to print our way out of our problems, that inflation could go much higher. And so people are reluctant to have a program that doesn't index for inflation. So some people say one way to approach this is to simply say, I'm going to give the insurance company even more money in the here and now. Maybe I'll give that insurance company $800,000, and they in turn will give me, say, $50,000 of income per year every year till I die. Well, and I may not need all $50,000 now, but that day will soon come. And therefore, I'm overshooting it in the short term so that I have enough income over time. What's the issue with that? See complaint number one, liquidity. You're giving up even more liquidity over your money in the short term, and that causes people even more heartburn. So that's not necessarily a solution that can really solve the inflation hedge in a satisfying way. The third problem that people have is what I like to call the Mack truck factor. This may seem a little macabre, but it's maybe, in my mind, it's a humorous way to deal with a macabre subject. The Mack truck factor simply says that if you step off a curb 2 years into having received your guaranteed lifetime stream of income, in other words, you handed $500,000 over to the insurance company, they started sending you $30,000 per year, and you got 2 years into that program, stepped off a curb, and you got flattened by a Mack truck. Guess what happens? That asset disappears. That $500,000 asset has disappeared off your balance sheet, and your heirs get 100% disinherited from that IRA. You may have entered into the proposition, into the transaction, thinking, hey, I've got that Methuselah gene. I'm going to live forever. I'm going to beat the insurance company at their own game. I'm going to, because it's a risk pooling proposition, I'm going to be that guy in the risk pool that lives forever. Therefore, I am going to get much more money out of the pool than the guy who lives the shorter life. The problem with that is, if you should step off that curb, get flattened by the Mack truck in some sort of unforeseeable event, that asset will disappear completely from your asset sheet, and that will be basically the worst investment you ever made. You gave them $500,000, you got $60,000 out of it. That other $440,000 went to the risk-sharing pool and goes to pay for someone who actually is going to live an abnormally long life. Now, that possibility, however unlikely, strikes fear into the hearts of many retirees and pre-retirees, such that they never, ever enter into the proposition. That whole possibility, they feel like they're always looking over their shoulder, wondering if they're going to die and have now be stuck with the worst financial investment that they've ever made and have their kids get cut out of the whole program. So 3 problems: liquidity, lack of inflation hedge, and what I call the Mack truck factor, the possibility that you could die prior to life expectancy and not get everything out of it that you put into it. Insurance companies are not unaware of the dissatisfaction that retirees and pre-retirees have with this approach, so they've done something to try to mitigate all of these risks, all of these sources of heartburn. So they've created a number of different types of annuities whose aim is to mitigate or soften the effect of these three things. The most popular of these, from what I've observed, is what's called the fixed indexed annuity. And they've basically created an annuity that gives you the possibility, you're not required to activate it, but gives you the possibility of guaranteed lifetime income. In other words, you can activate the income feature and have that income come to your bank account every month until you die. You're not required to, but it gives you that possibility. And they've built in some features that help soften the blow or mitigate, if you will, the three issues that we've stated previously. How do they solve the liquidity problem? They basically say in what we call the deferral period, which is the period while your money's growing before you decide to elect a lifetime stream of income, they allow you to withdraw 10% of that annuity per year. Now you may be thinking, wait a minute, 10% is not full liquidity. It's not full liquidity, but if you think of it in terms of the 3% rule, how in your stock market portfolio, you should never take out more than 3% of your assets in any given year. If you could take out 10% of that annuity, that's a smorgasbord of liquidity. It's like Mardi Gras. You can take out up to 3 times what you're really mathematically supposed to be taking out. They give you that liquidity fix. And this seems to be striking at the heart of the concern for most retirees. So that mitigates that risk, if you will. The second one is that inflation hedge. What do they do to fix the inflation hedge or the lack of the inflation hedge in the SPIA? What they've done is they basically said, when you give the insurance company your money, they are putting it into a growth account that's linked to the upward movement of a stock market index. And if the stock market goes up, you get to keep that growth up to a cap. If it goes down, they simply credit you a 0. I would say that a reasonable rate of return to expect in this type of an approach might be 3 to 4%. So you're not hitting it out of the park. But remember, your goal with this program is not to try to hit it out of the park. It's simply to guarantee a stream of income until you die that can keep up with inflation. And guess what? That income, once you elect it, is indexed. It grows right along with that underlying index. So if that underlying index performs at, say, 4% in a given year, your income actually increases by 4% that year, and it never gets any smaller. So they've really found a creative way to satisfy people that had an aversion to the SPIA because of that lack of inflation hedge. So they have a way. Now, it's not guaranteed, but if you look at all the back testing, it seems to be able to keep up with inflation over time. So that's a great flexible way to be able to make sure that your income keeps pace with inflation. And finally, they offer a death benefit. Essentially, what they say is, hey, whatever you don't spend, let's run with that same example of you take income for 2 years and then you get flattened by a Mack truck. Here's how it would happen in the fixed index annuity. Now, there's other types of annuities that can accomplish this, not quite in the same way, but the fixed index annuity seems to be the most popular way. And what happens with the death benefit is whatever you don't spend during that first 2 years prior to getting hit by the Mack truck goes to the next generation in addition to any growth on that money. Okay? Take that $500,000, subtract the money that you've taken out, add to it the growth that you've experienced along the way, and that is what goes to the next generation in the form of a death benefit. So never at any moment are you looking over your shoulder saying, gosh, I really hope I don't die, because if I do, that asset is going to disappear from my balance sheet and my children will become disinherited from that particular retirement asset. So I know what you're thinking. This seems like the alignment of the stars. What could possibly go wrong? And this is where we get to the fly in the ointment. The fly in the ointment is that my observation within our industry is that 99% of these fixed index annuities get implemented within the tax deferred bucket. And as I've said over the past couple of months in a variety of podcasts, there's two major issues that I have with that approach. Number one, if you have that guaranteed lifetime income, FIA, fixed index annuity within your tax deferred bucket, and you draw that income, that can never really be undone. You have set in stone the fact that your guaranteed lifetime income is going to be coming out of your tax deferred bucket, meaning you are once again exposed to the impact of rising tax rates. You're exposed to tax rate risk. So, for example, the $30,000 that we talked about earlier that you're getting, the money that you get after tax might be perfectly enough to meet your lifestyle needs in the here and now. But what happens if tax rates double over time? Now, all of a sudden, you have a hole in that guaranteed lifetime income, and you've got to find a way to plug that hole. How do most people do it? They go over to their stock market and they say, I'm going to make it up by taking money out of my stock market. If the stock market happens to be down in a given year, you're taking money out of the stock market during a down year, which exposes you once again to sequence of return risk. The act of compensating for tax rate risk in the tax deferred bucket could force you to spend your money down a lot faster than you ever thought possible. The second issue is that when you take money out of your tax deferred bucket, even if it's in the form of guaranteed lifetime income in a fixed index annuity, it's going to count as provisional income. It's going to count against the thresholds which cause Social Security taxation, which means you're increasing the likelihood that your Social Security gets taxed. If your Social Security does get taxed, and most likely it will in this scenario, you now have a hole in your Social Security. How are you going to plug the hole in that Social Security? Of course, by going over to your stock market portfolio and taking distributions in an up market or in a down market, taking distributions from your stock market portfolio, paying tax on that amount, and then taking the after-tax amount and using that to plug the hole in your Social Security. The combination of these two things, tax rate risk and Social Security taxation, could force you to spend down your stock market portfolio 12 to 15 years faster than you otherwise would have had you not been exposed to these two risks. So really the three big risks when you take this approach, you're still exposed to tax rate risk, you're exposed to having your Social Security tax, and the combination of those two things is going to force you to spend down all of your other assets that much faster. All right. Next week, we are going to talk about, by the way, actually, I think I'll save that for next week. We're going to talk about how some insurance companies have gone about trying to mitigate this risk. We're going to talk about the problems with the traditional approach of mitigating the issues we've discussed today. And then we'll show you a revolutionary way that strikes at the heart of what I talk about in my new book, Tax-Free Income for Life. We'll talk about a revolutionary new way to mitigate all of these issues such that you can completely remove tax rate risk and longevity risk from your retirement. These, in my mind, are the two greatest risks you'll encounter throughout your retirement: tax rate risk, longevity risk. Historically, financial advisors have attempted to mitigate one of those risks at the expense of not being able to mitigate the other risk. So it's always you pick one or the other, but you can't ever do both. Okay? Two drowning people in the water, you have to save one of them, but you can't save both of them. I'm going to show you next week how you can mitigate both of those risks in a way that restores peace to your retirement. Once again, if you would like to buy a copy of my book, I'd absolutely be honored. Head over to Amazon or wherever you buy books and just purchase a single copy. Please purchase the hardback. That counts towards our bestseller numbers. The Audible and the Kindle do not. So if you can purchase a hardback, we'd really be honored and really, truly appreciate it. If you're looking for someone to help you with all this, head over to davemcknight.com. And if you're a financial advisor that wants to learn how to implement this in your own practice and help your clients get to the 0% tax bracket and mitigate longevity risk in their retirement, head over to powerzero.com. Thank you for being on the webinar today. As always, we don't take it for granted and look forward to seeing you same time next week.